Let's get real for a second. Every bull market in history has one thing in common. It ends. And when it ends, it doesn't whisper, it screams. The question is, are we about to hear that scream in 2025? Look, the headlines make it sound like everything is fine. The SP is at all-time highs, the tech sector is booming, AI stocks are breaking records, and everyone is convinced we're living in a golden age of growth. But history? History tells a different story. Because every single time investors believed this time is different, it wasn't. Remember 1999? The dot-com bubble? The Nasdaq skyrocketed 400% in just 5 years. Everyone thought the internet was unstoppable. Then 2000 hit, and boom. The market lost 78% of its value, trillions wiped out. And the people who were sure it would keep going, they were left holding the bag. Fast forward to 2008. Housing prices had never fallen on a nationwide scale, or so they said. Everyone thought real estate was a guaranteed win. Then Lehman Brothers collapsed, banks failed, the market plunged over 50%, and the world realized how fragile everything was. So here's the scary part. Right now, as we move into 2025, the same warning signs are flashing. Valuations are stretched beyond reason, credit markets are under pressure, and geopolitical tensions, they're off the charts. But the big question is why 2025 specifically? Why could next year trigger the next big crash? It comes down to 3 ticking time bombs. 1. Interest rates and debt. 2. Corporate earnings reality check. 3. Geopolitical and global supply chain chaos. Let's start with the first one. Interest rates and debt. For the last decade, we've been living in an era of cheap money. Zero interest rates, endless liquidity, stimulus packages. It was basically free money for everyone. Companies borrowed like crazy. Governments printed like there was no tomorrow, and consumers? They loaded up on credit. But now? That era is over. The Federal Reserve has hiked interest rates to levels we haven't seen in decades. Why? Because inflation spiraled out of control after the pandemic stimulus. And higher rates don't just slow spending, they crush debt-heavy companies. Businesses that borrowed billions when money was cheap? They're now staring at massive refinancing costs at double or triple the old interest rates. Here's the problem. Corporate America owes over $12 trillion in debt. Much of that matures in the next 2 years. And guess what? They'll have to refinance at these sky-high rates. That's a recipe for bankruptcies, layoffs, and collapsing stock prices. But that's just one piece of the puzzle. Because while companies are drowning in debt, stock valuations are screaming bubble. So let's move to the second ticking time bomb. Corporate earnings reality check. Right now, the stock market looks like a rocket ship. But here's the truth no one wants to talk about. Corporate earnings aren't keeping up with these sky-high valuations. Companies are being priced like they'll grow forever, but history proves that's a dangerous bet. Take the SP 500's PO, E ratio. That's the price-to-earnings ratio, a key indicator of how expensive stocks are compared to their actual profits. Historically, the average P/CAO for the SP 500 sits around 15 to 16. Today, we're pushing 30. That's almost double the historical norm. Do you know when else that happened? 1999, right before the dot-com bubble burst. And 2007, just before the Great Financial Crisis. But it gets worse. A lot of this market rally is being driven by a tiny group of mega-cap tech companies, the so-called Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia. These companies alone make up over 30% of the SP 500's value. That means if they sneeze, the whole market catches pneumonia. And here's the scary part. Most of their recent growth is based on AI hype. Everyone's betting that artificial intelligence will change everything. Nvidia's stock exploded over 200% in a year because of AI chips. Microsoft and Google are pouring billions into AI models. It feels like the early 2000s all over again, when every company slapped "calm" on their name and their stock tripled overnight. But let's be real. AI is powerful, but it's also massively overhyped. It's not replacing entire industries overnight, and profits from AI haven't even started flowing in at the scale investors are pricing in. This is classic bubble behavior. Prices racing ahead of reality, and guess what happens when reality hits? Disappointment. Earnings miss. Guidance gets slashed. Stocks tank. The AI bubble could easily be the pin that pops this entire market. But the problems don't stop at tech. Across the board, consumer spending is slowing down. Inflation has crushed household budgets. Credit card debt in the US just hit over $1.3 trillion, the highest ever. People are maxed out. Student loan repayments are back. And guess what that means for companies that rely on consumer spending? Lower sales, lower profits, and eventually, lower stock prices. So, we have a perfect storm brewing. Companies priced for perfection, earnings growth slowing. Consumers tapped out, and Wall Street? They're still partying like it's 1999. But when the music stops, it's going to get ugly. Now let's talk about the third and final ticking time bomb: geopolitical tensions and global supply chain chaos. Because even if the economy was perfect, which it's not, global politics can still blow everything up. Now let's break down the third ticking time bomb: geopolitical tensions and global supply chain chaos. Here's the truth. Markets don't crash in a vacuum. There's always a trigger. And right now, we have multiple potential triggers around the world, each capable of sending shockwaves through global markets. First, China and Taiwan. Taiwan isn't just another country. It's the heart of the global tech supply chain. The Taiwan Semiconductor Manufacturing Company, TSMC, produces over 90% of the world's most advanced chips. That means every iPhone, every AI server, every electric car relies on those chips. If China invades Taiwan or even blockades it, global tech production stops. Instantly. No chips, no gadgets, no AI boom. The entire stock market would get obliterated. Experts say this would make the 2008 crash look small. Now add Russia and Ukraine. That war is far from over. In fact, it's escalating. And it's already caused massive disruptions in energy and food prices. Europe is scrambling for energy security. Countries are spending billions on defense. All of this fuels inflation, which forces central banks to keep interest rates higher for longer. And higher rates? They crush stock markets. And then, there's the Middle East. Oil is the lifeblood of the global economy, and any conflict there can send oil prices skyrocketing overnight. If crude jumps back to $150 a barrel like it did in 2008, inflation spikes, the Fed panics, rates stay high, and markets tumble. But geopolitical risk isn't just about wars. It's about trade wars, too. The US and China are already in an economic Cold War, slapping tariffs, restricting tech exports, banning chip sales. That's choking global supply chains and creating uncertainty for multinational companies. And markets hate uncertainty. And if you think these risks are hypothetical, think again. Every major market crash in history had a trigger. 1973 oil embargo. Stocks fell 48%. 2001. 9/11 attacks. Markets plunged. 2020 COVID pandemic. Fastest crash in history. So, here's the big picture. We're sitting on a pile of economic tinder, sky-high valuations, massive debt, overhyped AI stocks, and slowing consumer spending. Add a geopolitical spark, and boom, the whole thing goes up in flames. Now, some of you might be thinking, okay, this all sounds terrifying, but what does that actually look like for investors? How bad could it get?